What's going on, guys? It's Ron here. Welcome back to the channel. And over the last 12 months, we've seen how bad news just kept coming in for us. We had the unemployment rate, it was at historically high levels at some point, and we've witnessed a sharp economic downturn. And at the root of it all, you had the global health crisis. It literally claimed millions of lives all over the world. Yet despite all of this madness, the stock market has literally kept rallying through the past year, hitting record highs like never before. And most of that is thanks to the financial policies that were issued by the Federal Reserve. And now, Fed Chair Jerome Powell is surprising us yet again with a brand new insight, which we will be discussing today. It's a prediction of what's going to happen to the economy in the near future, as well as how it's going to affect stock market prices. Now, that on its own is already a must know, right? Will the Dow Jones hit 40,000 points in the next 12 months? Or is the Dow Jones headed back toward 20,000 points? So you need to stick around until the end of this video, because I'm going to tell you about how investors just like us can use all of this information in order to take control of the situation that we're in right now, and also that we're expected to be in over the next months or so. But before we get into all that, I just want to encourage you guys to go ahead and subscribe to the channel, tap the notification bell. I will be uploading more videos like this one, as well as stimulus updates soon, and definitely hopefully you won't miss out on any of that. More than a year ago, the stock market hit rock bottom after the virus outbreak caused some of the largest ups and downs in stock market history. But now, over 12 months later, we might still be in the midst of this crisis, but stock prices are once again near all-time highs. And one of the prime movers of that is the Federal Reserve and their use of some monetary policies such as quantitative easing and lowering interest rates. Now, this alone would tell us, perhaps more clearly than ever, that the Fed is the most influential body of the US when it comes to moving the stock markets. And as stock market investors, we have to be aware of even the slightest hint of action from the Federal Reserve, because of course this could ultimately affect us. Now, if you guys can remember, last September, the Federal Reserve reaffirmed that it will keep interest rates low at least until 2023. And we all know that interest rates control the flow of money to businesses. And so if interest rates are low, then there is more incentive for a business to want to borrow money for projects such as, expansion or maybe even high yield investments. Now, on the other hand, if interest rates are high, then business expansions are going to come at a much slower pace, ultimately making stock prices move slowly. Now, because the relationship between interest rates and the stock market is inversely proportional, as the two tend to move in opposite directions, the general rule of thumb here is that, when the Federal Reserve lowers interest rates, the stock market goes up. And of course, when they raise interest rates, the stock market tends to go down. And to further prove this, you can actually refer to market history from a couple of decades ago, where we've seen how low interest rates fueled some of the largest bull markets to date. So for example, in the aftermath of the dot-com bubble, we witnessed a bull market that lasted for around 5 years. This spanned from October 2002 to October 2007. And this was caused by easy access to credit, as well as, you guessed it, low interest rates. So clearly, interest rates, which are controlled by the Federal Reserve, really have the potential to directly affect the future and the direction of the entire stock market. But still, with all that being said, you should definitely remember that there's still no guarantee how the stock market is going to react to any given interest rate change at any given point in time. And also, what we've just talked about is how interest rates have affected previous stock markets. Now, of course, there's no guarantee that what we saw previously will affect future stock markets. However, it is a very good indicator. But here's the thing, according to Federal Reserve Jerome Powell, the US economy looks to be strengthening once again. And in his remarks before the Committee on Financial Services and the US House of Representatives just last Tuesday, he said that indicators of economic activity and the employment have turned up recently. Household spending on goods has risen notably so far this year, although spending on services remains low, especially in sectors that typically require in-person gatherings. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production has also picked up. And he went on by saying, as with overall economic activity, conditions in the labor market have recently improved. Employment rose by 379,000 in February, and the leisure and hospitality sector recouped about 2/3 of the jobs it lost in December and January. The recovery has progressed more quickly than generally expected and looks to be strengthening. Now, he's crediting this economic upturn to monetary policy actions that the Federal Reserve used, one of which, again, lowering interest rates, as well as fiscal policies of the government that includes the recently passed $1.9 trillion stimulus bill, which allowed eligible Americans to be able to receive stimulus checks, among other benefits. So yes, it definitely looks like we're headed toward another economic rebound. But now that's great and all. However, the thing is, once the economy bounces back, the Fed would no longer need to use monetary or financial policies such as lowering interest rates in order to support consumers. And as we all know what high interest rates could mean. But now, as more vaccines are rolled out, the overall economy is also expected to be able to recover faster. Now, while that is one of the main reasons why President Biden put forward the American Rescue Plan in the first place, people are still saying that all of this government support will eventually lead to inflation. And take note, Jerome Powell confirmed the possibility of that, saying that we do expect inflation to move up over the course of this year, and he stressed that it's true, we might see some upward pressure on prices. However, he did assure that, and I quote, "Our best view is that the effect of inflation will be neither particularly large or persistent." And he's looking at ensuring this by maintaining an inflation expectation. I'll explain more on that a little bit later in this video, as well as how you can use this information to make smart adjustments in your investment portfolio. But first, let's quickly discuss the Federal Reserve's prediction on inflation. Initially, it was projected that the inflation rate for 2021 would be around 1.8%. However, recent statements from the Federal Reserve, they imply that the new estimate for this year climbed up to 2.4%. Now, there wouldn't be much of a difference between the prediction and the Fed's target to maintain a 2% inflation rate every year. So in that sense, it wouldn't be much of a problem. However, the adjustment from 1.8% to 2.4% is pretty substantial. But Jerome Powell said that there's nothing to worry about, but he assured us that they have the tools to be able to deal with that, and went on to elaborate a little bit more on this, where he wrote, "The recovery is far from complete, so at the Fed, we will continue to provide the economy with the support that it needs as long as it takes." So basically what he's saying is that the Federal Reserve will continue using policies to maintain its traditional 2% target for a certain period of time. And so more than likely, this means at least until the economy reaches the previous levels of unemployment. Now, the big takeaway here is that they could continue doing what they've been doing in order to keep the market bullish over the past few months. Then investors like us could also expect to continue seeing, a longer bull run. And we've actually seen this historically. So if you're looking for long-term gains, who isn't, right? Then our best bet at this point would be to go along with stocks. Now, of course, this is not investment advice. This video is not investment advice. Just want to kind of open your eyes up to what is going on and what has happened historically. And again, it's no guarantee, but with all the information that we do know, I'm pretty much assuming that it's a safer option than to say, hold on to bonds. And especially now that the Federal Reserve has announced that it will not extend the capital rules for banks, which were eased last year in a temporary change to the supplementary leverage ratio, or the SLR. Now, that allowed banks to exempt government bonds from being treated as assets in the calculation of their SLR, so they could loan more money with less capital on hand. But at the same time, not extending relief on capital rules is now sending long-term bond yields higher. And we know that when yields go up, bond prices tend to go down. So obviously the Fed really has a say-so on how markets move. And knowing about all of their recent statements and actions will really help you guys to be able to take control of this, as well as future situations, and allow you to be able to, adjust your investment portfolio to take full advantage of this. But anyway, that's all for now. If you guys like this video, make sure you hit the like button. And if you guys want to see more videos like this one, definitely subscribe to the channel, tap the notification bell, and I will see you guys on the next one. Take care.